provide you with some of the financial slash tax tips out there for some business owners. But before we start, we'll do a quick market week. So this report is as of the market closed last Friday. And so stocks fell early last week while the Dow dropped below 20,000. Yields on long-term treasuries receded as prices climbed with increased demand. And so the market, it was pretty decent last week, but it did slow down just a little bit. However, news that the Federal Reserve was not raising interest rates this month, coupled with a favorable jobs report and the potential for regulatory reductions from the White House, seemed to rally equities by week's end. And so really some things to look out for in the future is that banks are slowly going to be deregulated, which opens up a lot of cash flow, a lot of money for business owners, and basically the economy is about to boom like crazy. What typically happens is that the stock market is going to go up, and the risk, however, is that whenever you deregulate something, some people might want to take advantage, and something to watch out for is just make sure that these banks don't get full advantage of us, basically. But overall, the market has been doing pretty good so far this year. I mean, the NASDAQ is up over 5% year to date, compared to negative 13% at the same time last year. So we're doing pretty good. Last year we started off terrible, horrible. I mean, it was one of the worst starts. It was actually the worst start to the stock market in history. And then also some other things. Price of crude oil went up from 53.12 to 53.86. Price of gold went from 1193.50 to 1221.90. And so that's just a quick market recap to make sure that you're aware of how the market is doing and kind of have an idea of where to put your money. And so now to jump into the meat of the presentation. So tax season can be a very, very frustrating time of the year. I mean, I know that some of the business owners I talk to, they don't know where to start. You know, they form this nice entity. They have a great business plan. They have such a great idea, but you know, you always have to make sure that your finances, your taxes, those type of things are on point at all times. And so my hope for today is that I'll be able to ease some concerns when it comes to this topic of taxes, and to get you in the right step or lead you in the right direction in order for you to know how to be best prepared for tax season, and basically to make sure that you don't receive a letter from the IRS. And then I'll also give you some tips, some really quick tax planning tips, just some things that you can take advantage of. I personally just finished my tax return yesterday, and it took me a long time, let's just say, to actually finish mine. It was extremely complicated because I have a lot of different things going on. You know, real estate, business, had a W-2 last year, so it was just a lot of different things. I went through a lot of different changes last year. And so my tax return is actually extremely complicated. But nonetheless, it's very important that you stay compliant with IRS or tax laws and regulations. It's very important. You don't want to have that letter. You don't want to get that letter from the IRS. You basically want to make sure that you stay compliant. That is very important. And if you own a business, the IRS will be looking a little heavy on your business. And so, to start off the process, so with this whole tax season thing, with this whole doing taxes, the process is you have to be organized. Organization is key. It's the most important step in the whole tax preparation process, or just taxes in general. So you always have to make sure that you're organized. Documents are in order. Registration documents are there. Summary of business income and expenses. Any receipts that you might have had. So you always want to make sure that you're organized. And keeping receipts is a good habit, but we're now in the digital age. We're computers. We're now where it's very easy to keep track of stuff. And so what I would say is that you should avoid doing things with cash. You know, if you have a credit card, debit card, if you can accept electronic payments, I would recommend that for you versus cash, even though there's fees associated with those things. The reason why is cash is very hard to keep track of, and it's also pretty hard to prove. You know, when you have a cash transaction, it's not the easiest thing to prove. And so to make your life easier, I would recommend just sticking to cards, whether credit card, debit card, accepting online payments. And I still know some businesses today that only accept cash, which, if you think about it from a client perspective, that's a bit of it's a disadvantage. Just because if I can go somewhere else and use my card, very convenient for me, versus me having to go to the ATM and taking out cash, I would say that you should have some sort of electronic payment system within your company. Not just for the inconvenience, not just because cash inconveniences people, but it's easier to track electronic payments. And then I would say Excel is also another great method. If you're using Excel, it's not a bad idea, but here's one thing that you definitely want to use, which is QuickBooks. QuickBooks is an accounting software that will basically automate your life. It will make your life so easy. You don't really have to ever worry about anything. Believe it or not, I'm an accountant, but I rarely ever see my books. The reason why is because everything is automated for me. And so once a month, I go in my books and see where how I'm doing, where my transactions are being classified, if anything needs to be reclassified. And so I barely touch my own books as an accountant. And so I would say that if I can do it, then anybody can. If I don't really have to go deep into this stuff, then really anyone can. And so you would think as an accountant, I'm heavily deep into my books. Nope. Once a month, I go in there, reclass some transactions, and then see how I'm doing from a profit and loss perspective. Seeing if I'm meeting my budget goals and whatnot. And then, so basically with QuickBooks, you buy the subscription. It's pretty cheap actually, and then you always get a free 30-day trial if you're just looking to try it out. And then so what happens is basically you put in your banking info, and then QuickBooks will automatically sync all your banking transactions. And so what happens is once you put in the bank info, QuickBooks is going to see all your transactions that went throughout the year. And what's going to happen is QuickBooks sometimes will automatically categorize them for you. Or you might have to do just some things in there manually. But the nice thing is once you put in a transaction, everything after that is automatic. And so once the banking info is there, you go in there and do some manual stuff, making sure that your basically all your accounts are being classified right. Maybe you like to call something one thing and QuickBooks calls it another. You can always change it. You can change it now, you can change it later. It's basically yours. It's your books, you control it. So it just makes life very easy. In the beginning phases, it might be a little difficult, but ultimately you get to control the books, you automate your life. If you have payroll, if you have anything that's a little complex, then maybe you might want to hire a payroll provider. But QuickBooks actually does provide payroll services. And so it's a very, very easy way to keep track of your documents, keep track of your expenses, your income. And it's not only for people with big businesses. It can be whether you have a sole proprietorship, you're a one-man shop. You would use QuickBooks Self-Employed. If you have, let's say you have 1 or 2 employees, then there's the next QuickBooks Online software, or QuickBooks Accountant. And so QuickBooks it makes your life very, very easy. And remember, as a business owner, you didn't get into business to do accounting. You got into business to do whatever it is that you set out to do. And so to be sitting there and doing your own accounting each and every day, having to worry about collecting receipts and those type of things, I mean, you imagine cutting out 3 hours of your day, or saving 3 hours of your day from reporting, because as we know, your books have to be in order. You always have to keep track of your finances or you're going to be behind. The one thing that kills a lot of businesses is the inability to track their finances. And so if you are tracking your finances and you're doing it manually, you might want to switch to a QuickBooks platform, because it's going to make your life easy, automated. And so your miles can actually be tracked automatically. And so this is a very, very nice tool. You don't ever have to worry about getting in the car, pulling out your phone, typing in, the mileage that you put on your car. I mean, you don't have time for that. You have time for running your business. You have time for meeting clients, and you have time for doing the things that you love and not doing tedious things such as tracking miles. And then, like I mentioned before, QuickBooks is very cost effective, cost efficient. I'm actually a certified QuickBooks Pro advisor, so I get to offer discounts to my business owners. And then the next step really is to actually prepare the tax return. And this is a very important part of the segment. You have to know what type of entity you are, whether you're a pass-through entity or you're a non-pass-through entity. And so pass-through simply means that all the business transactions flow directly to your personal tax return. And I'll show you how in a minute. Pass-through entities include sole proprietorships, or LLCs, single-member LLCs taxed as a sole proprietorship, partnerships, or multi-member LLCs taxed as a partnership, and S corporations all have pass-through or flow-through taxation. So a sole proprietor files a Schedule C, or if you're a farmer, you file a Schedule F. And then a partnership files a 1065, and then the K1s, so the 1065 generates K1s, which goes directly to the partners for the partners to put on their personal tax return. And then S corporations file an 1120S, and then the K1s get sent to the shareholders, and then the shareholders put that on their personal tax return. And so these entities don't actually pay taxes. You as the owner, everything flows to you, and then you pay the taxes on your personal tax return. But keep in mind, if you're getting some big deductions from the partnership, this can prove to be a benefit, because any write-off that the partnership is going to get, you're also going to get. And then the only non-pass-through entity is a C corporation, or an LLC taxed as a C corporation. And then the C corp files a Form 1120. And remember, there is no pass-through taxation, and so no items really other than salary flow directly to your personal tax return, and dividends as well. But I mentioned basically that an LLC can be taxed 3 different ways: a sole proprietorship, a partnership, or a corporation. So it's pick your poison when it comes to LLCs. And so you can go through all of this headache, all this madness, all these forms by yourself, or you can seek the help of a qualified tax professional, which is always the recommended strategy. And then always keep deadlines in mind. And so the deadlines have recently been changed. Partnerships and S corporations now have to file by March 15th. And then sole proprietorships and C corporations have to file by April 15th. Or actually April 18th, since the tax deadline got moved forward by 3 days. And then utilize tax planning strategies. So tax planning, what that does is it really goes through scenarios, strategies, different things that can affect your tax liability. And so what you want to do is you want to sit down with a tax professional and make sure that you go through, for example, S Corp versus C Corp. Maybe you don't want to be double taxed. So all C Corps are double taxed. And double taxation just means that you get taxed once on the earnings the company makes, and then you also get taxed on the dividends that are distributed from the company. And so maybe you don't really like this. And so you have a C Corp. All corporations start out as C's. So you have to switch to an S. One of my professors always told me, anytime somebody always presents you with the default and that's it, there's typically something better out there. And so if the IRS is only presenting you a C Corp, S Corp is probably better. And so if you don't want that double taxation, you might want to move to an S Corp, which is flow-through taxation, meaning you only get taxed on basically the earnings of the company. And so other tax planning strategies, whether you want a large, so for example, if you have a C Corp and let's say you made $1 million, that $1 million never gets shown on your personal tax return. If you have an S Corp, that $1 million will show on your personal tax return. So maybe you have a student, you have a child going to college, and they want financial aid, but clearly $1 million won't get them. $1 million showing on your personal tax return won't get them financial aid. But if you have a C Corp, the IRS doesn't see anything, and so there you go. There goes one of the loopholes out there, is that some people use C Corps in order to shield their income from showing on their personal tax return. So that's a tax planning strategy for you right there. Other things is sometimes certain retirement plans are better under C versus S or S versus C. It's just a bunch of different things, and so that's what tax planning is it goes through strategies, scenarios, and those type of things to make sure that you're really maximizing on your money, your benefits. And then remember, so here's the secret to the tax code. The tax system favors owners. Why is it that homeowners get a benefit or a write-off for the interest they pay, as well as the taxes they pay? Why is it that business owners get way more write-offs than W-2 employees? You know, why is it that car owners get to write off, or if you own a car in a business, you get to write off certain things, you get to depreciate the car? And how come renters only get to write off the rent that they get? Or if you're not a business owner, you don't get to write off anything basically when you rent. And so the tax system favors, or even let's compare life insurance, permanent whole life. I mean, not whole life, but just permanent in general, permanent cash value life insurance versus term life insurance. Why is it that you can shield your income through a whole life or permanent life insurance policy and not through a term life insurance policy? So it's really, if you own something, you're probably going to get a benefit from the IRS. And so that's one thing to keep in mind. It's very important to know, is that the tax system favors those who own and not those who rent, or not those who are employees. And then, so just some general business expenses or business deductions out there that you can write off are your typical ordinary and necessary business expenses, such as meals and entertainment, anything, a new laptop that you might have bought, a new car, that new Audi that you really like that you bought for your business. You can basically write all of that off. As long as you're staying within yourself, you're staying within your means, you can basically write off anything as a business owner. And then also your medical insurance premiums. Why is it that business owners can write this off straight up versus an employee who has to itemize in order to do this? And they're limited to 10% of their AGI, or they have to cross 10% of their AGI. Why is it that a business owner doesn't have to do this? Like I said before, the car, you can basically write off your car as a business owner. And then retirement contributions. Business owners actually can save way more for retirement than regular employees. So the different the different types of retirement plans out there for business owners are payroll deduction, IRA plans, simplified employee pension plan, or the SEP plan, which is a very famous plan out there, the simple IRA plan, the simple 401k plan, the individual or solo 401k plan, which is probably the most popular out there, and then the key-off plan, which is a qualified retirement plan established by a self-employed individual or a partnership. And so I'll talk about two briefly, because these other ones, they're not very popular. And so the SEP plan and then the solo 401k plan are two of the most popular retirement plans for business owners. So with the SEP plan or the SEP plan, it's very easy to establish. It's for people who have some employees, and you can contribute up to $54,000 in 2017. And so really per year you can contribute up to $54,000. And then you get to write off a certain portion of that. There's certain rules that apply to that. And then also you have the solo 401k plan, which is mainly for solopreneurs or solo entrepreneurs, sole proprietorships. And so you can also contribute up to $54,000 a year, but here's the catch. You can't have employees. And so the reason why this might be a bit limited is because if you want to expand your business, you would have to move away from the solo 401k plan into maybe a SEP plan, or maybe a simple IRA plan, payroll deduction plan, something other than a solo, because that's why solo is in the name. It's only for one person. Or if you have a wife and then they work with you, you can also have a plan for them. That's really probably the only exception is that your spouse can be under the plan as well. But I would say tax system really truly favors those who own. Whether you're a homeowner, business owner, life insurance policy owner, anything that you own, a car owner, anything that you own typically favors you from the tax system. And I always say that the system was created against us, but we have to find ways to actually beat the system. We have to find ways to own the system. And the way to own the system is we have to own stuff. And so all these nice write-offs, there's so many beautiful, very, very nice write-offs for business owners. I encourage everyone to take advantage. I mean, I know for a fact I took full advantage of my write-offs from my tax return that I just completed last night. And then always stay organized, always stay compliant. The IRS is not to be played with. I just talked about a million write-offs out there, but you always want to make sure you stay in your lane. You don't go overboard. You don't do anything too crazy. Definitely don't do anything illegal. And so always stay compliant with the IRS because they will come after you if you don't. So keep in mind that there's always ways to minimize your taxes. I know Warren Buffett, there's a famous statement out there that he basically pays less taxes as a percentage than his own assistant. And then he basically feels sorry for his assistant. He's like, man, look at this person. I'm paying less taxes as a percentage, as a billionaire, as the top 3 richest person in the world. And I'm paying less taxes as a percentage than my own assistant. And so I would say one person that you have to have in your system and your network is somebody who knows tax law. Somebody who can really benefit you, somebody who can really maximize your money. Because remember, it's not about how much you make, it's about how much you keep. And taxes are a big part of how much you keep. I mean, in 1944, the highest tax rate was 94%. So if you're only keeping 6% of your money, but you're making $1 million, that's nothing. And so always keep that in mind. You know, the tax system is extremely complicated, but if you know someone or if you know the tax system, which I don't think you would if you're not a tax professional, but if you know the tax system in depth, you should really be able to maximize on your money. And that's why one of the mission statement of my company is to maximize your financial security. And so keep in mind that taxes are a huge part to do with your financial security. Because if you're making a certain amount of money and the government is just taking everything, then you're not really making money at the end of the day. And so that's always something to keep in mind. It's not about how much you make, it's about how much you keep. And typically your rate of return, typically anything that has to do with how much money that you're putting back in your pocket, that's all financial security is about. It's about keeping the most money in your pocket. Not living scarcely, but however, just taking advantage of different strategies. For example, if you have a business, there might be some things that you don't know about. And so what I would do as a tax practitioner is, it is my job, it's actually a legal responsibility that I have to save my clients the most amount of money on their taxes. But I sort of take it a step further and go beyond the taxes. And so I'll give you some tips, tricks about other stuff too. And so taxes are definitely a huge part, but you always want to make sure that you truly maximize your money and make sure that your money is in the right vehicles. And one of the big secrets is basically doing traditional versus Roth IRA. I talked about that a few times in the past, and how employers are basically setting people up for traditional IRAs. I mean, not traditional IRAs, but traditional 401ks instead of Roth 401ks when they're starting out. And so that's one thing. That's one setup for failure. And so I don't know what's wrong with the system, but truly the system was built against us. So we really have to find ways to get around the system and utilize strategies such as tax planning strategies to really make the most out of our money. And so that's really it for my presentation today. Thank you guys for tuning in.
Keep talking.
Next week we'll definitely be talking about some more, talking about home ownership. So whether you should buy versus rent. It's a topic that's been debated for, probably over 100 years or so now. And so we'll definitely talk about that, talk about some of the benefits, the pros and cons. Some people think renting is throwing away money, which is true in a way, but there's more to that than just that. So next week we'll definitely be talking about that. Thank you guys definitely for tuning in. It's always a pleasure. It's a blessing to be able to be on the show. Your contributions are always welcome. And of course, tax deductible. So that's one way to make the most out of your money, is to utilize WGHC 98.3 FM as a tax shelter and continuously contribute. Thank you.